Welcome, everyone, to our latest episode of Digital Davos 2024. I'm here in Davos, Switzerland, in a cold alpine January, and I'm pleased and proud to be joined by our guests, Philip Wiseman and Delia Sabau, joining us via Zoom. Firstly, just maybe we can all briefly introduce ourselves. So I'm David Doss. I'm the founder of CKC Fund, which is an emerging fund management company focused on the digital asset space. Philip, perhaps you could introduce yourself as well. Welcome.
Sure. Well, first off, thanks for having me, David. As David alluded to, my name's Philip Wiseman. I'm an attorney in the state of Texas. I have better part of a decades of experience working with private investment funds, private investment vehicles, private investment deals in the Americas, throughout Europe, across Asia and Australia, having practiced both in Europe and the United States. And when it comes to the subject of emerging markets or new asset classes like digital assets, virtual currencies, it's definitely something that I've spent quite a bit of time writing about, researching, and consulting clients on.
Wonderful. Well, glad to have you here. And Delia, welcome as well.
Thank you. So I'm Delia Sabau. I'm the head of the portfolio and risk management for CKC Fund, which, as David mentioned, is an emerging hedge fund. I have more than 20 years experience in traditional finance, starting literally as an equity research for Barclays Global Investors that later became BlackRock. And I started managing hedge funds in a more traditional ways, moved into the digital assets and alternative investments 2 years ago. So it's an exciting space to be in.
Absolutely. So to some of your points, Delia, about the different asset classes, kind of different sectors that you've been looking at through your career, the topic of our presentation, our panel today, is emerging fund managers and emerging asset classes, challenges and opportunities. So while all of us have, I think, a lot of interest in and experience in the digital asset space in particular, we also have seen served a lot of time in other asset classes as well. So Delia, to start things off, maybe you could give your thoughts on the alternative asset space in general in recent months, in the last year or two, in the wake of rapidly rising interest rates, inflation, geopolitical tensions, various other factors. What shifts do you see having happened already in the alternative asset space, and what are the opportunities and challenges that you're looking at going forward in the near future as well?
Yeah, so over the last few months, we definitely saw a big shift, I would say, in alternative investments or emerging kind of asset classes. We see that with the kind of introduction of the Bitcoin ETF that draw a lot of attention, and a lot of kind of institutional investors started paying attention to this kind of new asset class. The benefit of adding those alternative or emerging asset classes to a bigger portfolio is that they have a low correlation with the traditional stocks and bonds. And this is because they're influenced by different market dynamics and economic factors than the traditional assets. So they usually respond to geopolitical events or inflation pressure in different ways than the traditional assets. And adding those asset classes to a traditional investment strategy increases diversification, which is critical because it spreads risk across various assets, and they can move in different directions during different economic cycles. Now, the caveat of adding those new emerging assets to traditional portfolios is not straightforward, because first, the risk associated with this new asset class is not very well defined. And the second, there is a need for robust valuation models. And right now, everybody kind of is struggling to build those models. So from a risk point of view, in traditional markets, you know that the work has been done right? So we have robust and very mature ways to measure and manage risk. We know that you have the financial risk, which is the market risk, the investment risk, the liquidity, the credit, the counterparty risk. And then you also have the non-financial risks, which are kind of the regulatory risk, IP, whatever, operational risks. So those are all acceptable standards that everybody is comfortable operating with. However, when you add those emerging new asset classes, then you have the new risk that comes with them. And in this case, is the technology risk, is the decentralization, the smart contract, the open source, composability. And they all are associated with this digital asset class, and they need to be really understood and quantified before adding them to the portfolio to do the diversification that is needed. On the return side, and I'll touch on this a little bit, is just that I always say that the risk and returns are the same side of the coin. Investors still need to build a very robust valuation models. And few months ago, I talked to a senior fund manager at a large bank about patterns in those new asset classes. And it's interesting because usually when the new asset class starts, the reaction is, don't touch it. Don't put it on my balance sheet. Don't allow to trade it. But the second phase is, oh, that's kind of interesting, but we don't have good models, right? So we are still using Excel spreadsheets to compute the expected returns. So don't get too big. So right now we are at this phase. This is where we have institutions saying that, yeah, maybe put 2 to 5% in digital asset. If it blows, it's not going to kill me, but we do have an upside, and I can actually learn how to model them.
That makes a lot of sense. So I know that, Delia, you mentioned regulatory risks. Question for you, Philip, around that. Both in the broader regulatory risks and opportunities in the alternative asset space in general, and then also what do you see in specific around digital assets in recent history and in the near future?
Yeah, so I think a great starting point is just to remember that whether it's a new asset class or a traditional asset class, if you are engaging in a private offering of securities or a public offering of securities, there's a regulatory regime that governs that. And when we look at what regulators have recently been doing, both here in the United States as well as abroad in places like the Cayman Islands or over in Europe, regulators are paying very much keen attention towards private market offerings. Are you disclosing adequately and properly the variables that an investor should be thinking about when entering an investment that you might be offering, as well as have you disclosed the risks of particular asset classes appropriately? And as Delia was alluding to, the risks surrounding things like modeling, computation of return on investment or IRR, those are going to work a little differently for things that are based on blockchain or cryptocurrencies or digital assets than, say, a traditional investment class like real estate or traditional private equity buyout or credit and finance lending. So when you're thinking about, as an offerer, what you should be thinking about, you want to be thinking about it twofold. One, are you complying with the traditional securities regulations? We see certain developments in that with things like the new marketing rule, with things like the Corporate Transparency Act that came into effect this year. And those are going to be kind of the traditional securities offerings regulations that you need to be concerned about. But when you look at the asset class risks itself, that's when the picture starts changing a little. You've noticed a lot of enforcement activity these last several months from the Securities and Exchange Commission, the Commodities Future Trading Commission, and even just the Department of Justice itself, when you think of these prosecutions of companies like FTX or Coinbase, Binance, Bittrex, or cases that are brought up for things like scams and fraudulent activities. I'm thinking of the Titanium Blockchain Services prosecution. And when these things occur, what you're actually seeing is a development of the regulatory regime. As regulators begin to crack down on bad actors, as they begin to publish regulations and guidance about what they would like to see in the market and best practices, and even as you might have new statutes come into effect, in Congress, they had introduced the Digital Commodities Consumer Protection Act in 2022, as well as the Loomis Gillibrand Responsible Finance Innovation Act. These are new statutes that might be coming into effect as well. So you really have the market waiting for this regulatory regime to mature, to develop, to become solidified so that, as Delia alluded to, investors would feel more comfortable adding new asset classes like virtual currencies into their portfolios, but we're still very much in the infancy of that. It's not like we have a 50, 100-year robust common law regime of how to treat cryptocurrencies or the exchange of virtual currencies or digital assets, or tokenizing existing securities and what those look like on either initial offerings or secondary offerings. So while the dust is still settling, I think one of the positive things you can see about that is that the market is maturing. People are beginning to realize bad actors that are coming in to create a bait and switch scheme are going to be found out. They're going to be prosecuted. There is no room for these bad actors in this financial realm. And that's going to give investors a little more confidence. At the same time, with just having a public market demand for virtual currencies, crypto tokens, etc., you're going to see private market actors have to deliver products in that space. And that's why you had the recently approved applications for ETFs tied to the price of Bitcoin. That's why you're having new exchanges that are popping up. That's why you're having private market actors take a look at this emerging asset class and go, well, we need to either offer this or we need to offer an ancillary service for this because there's a market opportunity. And when you tie a maturing regulatory regime with emerging market opportunities, you end up getting more investor confidence in the products that you're offering, in the products that you're delivering in the space. And I think that's why you're going to see in 2024 and beyond continuing regulation and maturity of that to match that continuing market demand.
Here. No, that makes a lot of sense. So I know that, Philip, you mentioned something interesting there about the asset evaluation process and some of the unique challenges. Here at CKC Fund, we like to say that crypto is special just like any other asset class. So, point being that, there can be maybe apples and oranges, slight variations maybe between something like real estate asset evaluation and crypto evaluation, but that doesn't somehow make it apples and chocolate cake or something like this. It's at the end of the day, it's still a fruit. So Delia, to that point from Philip, what are your thoughts on some of the unique challenges as well as opportunities around asset evaluation within the alternative asset space, and especially within an emerging alternative asset class such as crypto?
Yeah, I mean, I mentioned a little bit earlier is that the problem that investors actually have is that it's a new asset class, right? So everybody's really struggling to build very robust valuation models, right? So in traditional finance, again, the work was done, right? So you definitely see a lot of analysts that know exactly what type of valuation they usually run. They have their DCF kind of spreadsheets. They go and sit in kind of companies' earnings calls, right? They take notes and they run all those kind of models literally real time, right? In the alternative world, it's a little bit different, right? Because everybody's kind of trying to figure out exactly what drives the price, right? So a few years ago, you only had the traders, right, in the digital asset space. And those traders were not looking at valuation, right? So the value was not something that was driving their investment. It was just the price, right? The intraday price or kind of very high frequency type of strategies. Now you are definitely with the industry maturing, you definitely see those models actually maturing, right? And you see a lot of hedge funds coming up and really kind of start building those kind of factor models or kind of looking at different type of scores or different type of modeling, right? So in traditional finance, you have a lot of kind of you'll call factor modeling, right? Where you go to the momentum. Momentum is still something that you can actually build in the digital asset space. But fundamental, the question is, what is fundamental in a digital assets or in an alternative type of space, right? So we look at different type of metrics. We look a lot of like on-chain or network type of metrics that can drive that quantitative fundamental kind of aspect of a particular asset, right? So all those models are evolving, right? We are still not at the stage or at the phase that I can say those are very robust. And the main reason I said we are not there yet, because to build robust models, you really need to back test them. You need to kind of test them through different economic cycles. And this asset is very new, right? So you can't really say, okay, it really works in a hyperinflation, or it really works if you have a really a shock in a geopolitical macro economic environment. And then you can try to really understand how it moves through those, and how what really, how should I say, how you can actually value and price that asset in different economic cycles. So yeah, so it's new, it's very interesting, and I would say in 5 years we'll get there.
It's definitely exciting times. So you raised some interesting points about kind of building out these new models. And so in keeping with the title of our panel discussion, emerging fund managers and emerging asset classes, it does seem increasingly in the current climate that there is a push to operationalize things. But this does seem, especially within the digital asset fund ecosystem, to be a largely bottom-up sort of an initiative, where according to research from PwC and other related institutions in the financial services space, you're seeing some of the larger institutions take more conservative bets and or kind of remove crypto from their cap table, at least to remove some of their crypto from their cap table in 2023 over last year. But then conversely, and somewhat ironically, seeing a lot of capital inflows into the crypto space, according to research from Reuters and others, where even though some of the big players have, let's say, taken on a somewhat more conservative position, net digital assets in 2023 were actually among the highest in terms of capital inflows for an alternative asset class. And so relatedly though, that another, I guess, perhaps slight irony, but in 2023, with that decreased institutional involvement in crypto, Bitcoin was actually the best performing assets of 2023, outperforming stock indices, bond indices, gold, oil, and various other indices. So there is a bit of an ironic kind of interplay there. But I guess as a related question, thinking of not just about emerging asset classes, but about emerging funds in particular, what are some of the opportunities and the challenges that you see, Philip, for emerging fund managers in the current climate?
Yeah, so I think part of chaos is opportunity to do something different, to take the road less traveled. A lot of what I was listening when Delia was talking about the modeling and the forecasting is that disclosures about the limits of those are going to be very important. And for two reasons. One, it protects who's disclosing the information. But two, it can also build that trust with an investor by saying, look, this is a relatively new asset class compared to other asset classes. So we've done our due diligence in understanding both the limits and the questions that need to be asked and answered moving forward while we're forecasting this information to you, while we're providing these projections. And I think that if an emerging manager and an emerging offer in this space is really able to build that trust with investors and say, here are the definitive limits of what we know today. So we're not going to have answers to these questions, but we know what the questions are. And we're going to be tracking these as we move forward in time. At the same time, we're tracking what's happening on the markets, both from the commoditization of things like the price of Bitcoin, as well as use cases for digital tokens, cryptocurrencies, whether it's buying groceries at the store, buying a next Tesla, or going on a family vacation. And if you're putting those in an offering prospectus to investors, building that confidence, identifying what those limits are, I think that an emerging manager has an opportunity to step onto the stage and say, we understand that this is new. We understand that this is different. And here's how we are going to provide the best value for this emerging asset class that, as you just referenced, in several aspects can outperform other classes. So if an investor is looking for a return on investment that can beat the market or beat other asset classes, if they're looking to diversify their portfolio and they have an investment manager that is building trust, that they can depend on, that they can rely on to provide clear disclosures, provide adequate market surveillance, and provide a product that can produce a return, I think there's an opportunity there to go out into the market and capture not only existing investors, but potentially new market players as well.
Interesting. So thinking through the role of emerging fund managers, I have something, a related theme top of mind from the last few days that here in Davos, there have been a number of different panels that were talking through peace and conflict, geopolitical risks, et cetera. And a theme I kept seeing was actually let the younger generation teach the older generation. That's not meant to be a mutually exclusive thing. I think we can all obviously agree that, you know, parents teach their children, educators, you know, teach the young, the students. But and I think we have talked so far about how you know, the crypto industry, for example, ways in which it can kind of grow up and mature, which is let's say the older generation teaching the new. But at the same time, just because a person or a nation or an asset class is adult or mature, doesn't mean it stops its need to evolve and to improve and to change. So with that in mind, Delia, are there any ways that come to mind in which emerging fund managers and or emerging asset classes like crypto can teach lessons to their more mature counterparts?
That's a great question, actually, because every time you have a new asset class, the reaction in the market is resistance. And it's just because it's completely unknown and you don't want to make mistakes. And stepping back a little bit, as a fund manager, you have a responsibility to your investors that you generate returns for them. And if you step into a new asset class that, as Philip was mentioning, there's no clear disclosure, there is a high risk that you can't really measure, you can't really quantify. You cannot go to the investor and say, I know what I'm doing. And even though I have this fiduciary responsibility to you, I'm going to step in and make investments in this new asset class. So there is a lesson to be learned there. But to put the new generation and the old generation, I think it has to be something in between, right? Because the new generation will always jump in head first and said, yes, that's exciting. I know a little bit of the risk. I know the returns, and I'm going to take it. The older generation is more traditional. It says, okay, step back and let me see if I quantify the type of risk, right? If I go in front of you and say very clear, I know exactly what I'm doing, right? And again, it's a gray area. It has to be that both areas need to learn, both generations need to learn from each other's, right? And it's not a clear answer, right? Because with those new asset classes, it has to be trust, it has to be security, it has to be something that I go and I know exactly that it's not going to be a scam, right? And we are early stage. I think we made a huge improvement over the last 5 years, right? And all the crypto skeptics now, they actually come and said, oh yeah, actually put some allocation into this new asset class, because we can understand that it can have some benefits, and we are at the stage that we can quantify a little bit the risk.
That makes a lot of sense. So to your point, Delia, about something in between, one potential way for that joining or that middle ground can be, I think, through partnership. Philip, you know, given your background, you know, you've interacted with sizes of corporation ranging from, you know, startup or emerging funds all the way to you know, ultra large institutions, so to speak. So curious, do you see any ways in which some of the larger and or older, more traditional institutions in the investment space can be collaborating with some of the younger ones, such as emerging fund managers?
Absolutely. I think that one of the values of having kind of diversity of experience and diversity of thought is that you can look at problems in new ways and find solutions that maybe the traditional set of people would be blind to. At the same time, the pace of information just historically has always been increasing. Although what we've now had difficulties is in the interpretation and translation of what that communication means. Whether it's interpreting slang on the internet or interpreting consumer habits and how people might be going about their daily lives, I think a lot of use cases for virtual assets are dependent on how people in reality would be using them. And to understand people, you have to listen to them. And to understand younger generations, you have to listen to younger generations. You have to work with younger generations. You have to work and partner with them, with their startups, with their companies, with their use cases. The hypothetical I would pose is that if everybody in Gen Z starting a business wants to use cryptocurrency, but there's not a payment facilitator, how in the world are you going to make a loan to their businesses? How in the world are you going to be a patron of their businesses? You can't. There's a divide in that understanding. But if you work with them, if you listen to them and you understand them, well, then you're going to be able to do business with them and invest in those areas of the market that you otherwise might have been blind to. At the same time, I think that the teaching is reciprocal. Younger generations may be coming into this, but they don't have the breadth of experience. They don't have that running track record. And whether the asset class is something like cryptocurrencies, or whether it's oil and gas, whether it's real estate, whether it's renewable energy, transportation, one of the things that you begin realizing is that while there might be specifics to new asset classes, at the end of the day, all asset classes are still asset classes. There is still the goal of marketing them or investing in them for a return. And there are these historical patterns that have occurred. As Delia was mentioning, new asset classes tend to be resisted by the market at first. Why? Because there are too many unknown variables. That creates too much of a risk. And when you compare them to other asset classes, people would prefer to diminish the risk and invest in the returns that the other asset classes are promising. But as regulations mature, as market demand continues, as people begin to work through these systems, that risk begins to be minimized. And as that risk goes down, what was a new asset class now all of a sudden becomes part of that traditional asset class. And I think that older generations can provide that experience to potentially maybe temper some of the unknown variables and risk when we're looking at, say, cryptocurrencies or digital assets, and realizing, okay, this isn't something that's completely different from anything that we've ever seen before. This isn't an alien from Mars. This is just a new asset class. And there are still the traditional private investment safeguards. There is still the need to develop trust between offerers and investors. There's still a need to communicate with regulators. There's still a need to have trusted advisors that can monitor what's going on, both in terms of what the government is doing, as well as what private actors in the market are doing. And I think the interplay between younger generations and older generations can help facilitate that conversation so that at the end of the day, whether you're an offerer, whether you're an investor, a partner, a service provider, or just an enthusiast of cryptocurrency, you're able to get a clearer picture and actually understand not only what the market state is today, but what it could be tomorrow, a year from now, 10 years down the road.
You bring up a lot of interesting points there, Philip. For one thing, this point about multiple asset classes playing a role. What we're looking to do at CKC Fund is to plug into the existing ecosystem. I think that some more traditional financial professionals and investors have a somewhat sour taste in their mouths from some of the earlier years of digital assets, where there were these sort of very reactionary type of a lot of very reactionary type of rhetoric. But looking at this in terms of bridging the old and the new together and balancing that is, I think, a really important point in terms of responsible, risk mitigated and successful investing. Beyond that, you also raise a point about alternative assets in general, and I agree. I think there are a lot of really exciting opportunities, not just in crypto, but in various other asset classes. For one thing, things that I have personally found interesting and exciting as potential investments for myself, have been things like they're starting to sprout up watch funds or fine wine funds, or a variety of these kind of more exotic funds, as well as more kind of exotic esoteric investments. But to your point again, just because it's not another planet, it's maybe just another continent, or even maybe just another country on the same continent. So still a lot of proximity. And lastly, your point about supply and demand, I think is really well taken. When we look at the demand for alternative assets such as crypto versus the supply of asset managers, private wealth advisors, and related, who actually provide those resources. So to Delia's point about the middle ground, one key way that I see as a way towards that middle ground and towards an equilibrium between the old and the new, and between an equilibrium between the supply and the demand, is collaboration, where you have an opportunity, for example, for more established wealth managers to partner with emerging fund managers in a way where each can learn from each other, each can rely on and grow through each other's infrastructure, because there are very different types of infrastructure required to operate, for example, a crypto fund versus a traditional asset management business. But then the traditional asset managers can provide these types of service through partnership to their clients in a way where they have, through partnership, some level of oversight and say on what is going on. So that spirit of equilibrium and collaboration is I think a beautiful one to leave things with. Before we end for the day, curious if either of you has any last thoughts on anything poignant that we haven't discussed yet, or any trends that you might suggest for viewers to watch out for. Maybe we can start with Delia.
Yeah, so as far as trends, I really think that this year, over the last actually 2 years, we'll see a huge adoption of tokenization. We didn't talk about that, but the real world assets and the tokenization of those assets will really have a huge impact on the whole digital asset market. So. And the main reason actually I said that because you can actually tokenize everything. Going back to your point, David, about the wine or everything, you can actually go and do real estate. You can do art. You can do precious metals, or even you can tokenize equity bonds or derivatives, and you can just convert them into the digital assets through this tokenization process. And by doing that, you create not only efficiencies because you eliminate the middleman for the settlements, but you also create the liquidity. And one thing that actually I want to draw a comparison here is that in late 90s or early 2000, you had this tokenization of stocks, right? And that was a huge boom for the retail investors that really converted into the financial services that really had a huge exponential growth, right? And via the tokenization, this is exactly what you're going to see, right? You're going to create so much liquidity in some type of illiquid assets that initially the investors could not buy because they may be too expensive, right? But now, because of this fractional type of shareholders that you can actually sell, they can actually buy and gain exposure to, right? So in my view is that this is the trend that I will really watch carefully over the next year or two. And then also with approval of the ETF for Bitcoin,
the
what
elephant
I
in the
really
room.
see
Yes.
is that is going to be, we'll see more and more those multi-assets ETFs coming online. And that again will drive a lot of kind of retail adoption, and it will make really investment into the digital assets more common, right? And more user-friendly, right? Because then you can actually go and buy exposure via an ETF, right? It's not only exposure to Bitcoin, but exposure to the multi-asset class, to an industry, to a sub-industry, which is part of the digital assets.
Those are great points. In particular, talking about the tokenization opportunity, a variety of really top global banks, global think tanks are forecasting this as a multi-trillion-dollar marketplace opportunity, the tokenization of real world assets by as soon as 2030, with projections ranging from between 5 trillion to as much as upwards of 20 trillion. So definitely some exciting opportunities there to look out for. Philip, anything you would like to leave the audience with?
Yeah, I think if you are looking to be on the manager side of things or the offerer side of things, knowledge is going to be one of your key essential tools here. And that's knowledge of federal, state, and international laws concerning not only private securities offerings or public securities offerings, if you're going down that route, but also the laws, regulations, and rules pertaining to your asset class. So in this case, digital currencies, virtual assets, tokenized securities, and making sure that you have a trusted advisor in this space. One of the difficulties of an emerging asset class is that there's an emerging regulatory regime that's going to be trying to catch up with the market. And that's going to be done on a state, on a federal, and on an international level.
Mm-hmm.
So when you're looking at who you're going to put your trust in as an advisor, be it accountants or auditors or lawyers or consultants, you want to make sure that they're staying abreast of the developments in the entire picture, not
Mm-hmm.
just one segmented small piece of that puzzle. So depending on what knowledge base they have, that's going to depend on what advice you're receiving, and you don't want to be caught flat-footed. You want to make sure that your trusted advisors are capable and do understand the overall picture of what's going on. And then the next part of that is, with that advice, you can make sure that you're compliant with those things. And one of the largest parts of compliance we've been harping on today is disclosure. Identifying what are the limits of your models, identifying what are the future challenges that you see that could risk not only your investment strategy, but completely blow your model if certain black swan events occur, as well as if certain limited knowledge qualifiers turn out to then be discovered and not be what you think they could be. So disclosing that up front, though, will not only protect you from a regulatory standpoint, but also help ensure with your investors that you have a trusted line of communication, that you're delivering the necessary information to them so that they can make a calculated risk, and that in turn drives the trust that you can deliver on the results that you're promising. And then lastly, pivoting. Like any other type of business, when market conditions change, be they regulatory adaptations or market appetite or new technologies or geopolitical events, if you need to pivot in your strategy, maybe something didn't pan out the way you were thinking, maybe there's a new regulatory block in the way, you need to be nimble enough and afford yourself enough room to make that pivot if you're going to survive in what's really a constantly changing marketplace. And that's not a bad thing. That's not something that's unique to this asset class. That's something that's market-wide in any asset class. It just happens that the frequency of those changes may be a little more fast-paced here than in other areas. And if you do all of those things, then kind of the last point I would bring up is that you want to make sure that you're delivering an actual value proposition to investors and your partners as well. And if you've done the other stuff, you're going to be in a much better position to deliver true value, whether it's this class, any other class, through a public offering, through a private offering, Davos, or in Austin, Texas, than it would be if you were just kind of scattered, only looking at half the picture, not paying attention to the regulatory or market developments.
Well said. These are some important things to, I think, for all of us to reflect on. And to that point, that is really the spirit in which my partners and I are here in the first place, in a place like Davos this January, where what we are looking to accomplish here is to be a part of these dialogues that are beyond just digital assets, because in various ways, digital assets touch and blockchain touch other things going on in the world, be that the tokenization of real world assets, as Delia is mentioning, or even just in relation to seeing the part that a digital asset investment plays in the larger tapestry of a business's plan or an investor's diversification strategy. Is important to be consistently looking through what is happening, not just in one specific space, but across spaces. So for that, my team and I at CKC are very grateful to Chain BLX, who is the organizer of the Digital Davos series, which has been both online as well as in person here in Davos. And this is something where we are glad to be a part of that conversation, and also to bring our investors and our partners into those conversations as well, to help them to see the kind of things that Philip mentioned, the kind of things that we are looking to see and are seeing here to help them to see those. So thank you both again for your time and for your insights, and look forward to potentially having you on board for another session in the future.
Thanks
Thank you for having us. Bye.
Bye.